Welcome to Chapter 18, Cross-Border Asset Gathering. In the last chapter, we followed investments across borders. Now we reverse the direction and follow the fund sponsor. Managing a strategy globally is one challenge. Packaging it, registering it, distributing it, servicing it, and making money on it across several jurisdictions is an entirely different challenge. A portfolio can travel electronically. A fund offering travels with lawyers, regulators, boards, depositaries, administrators, tax specialists, data teams, distributors, and local client service people. That is a much larger travel party. This chapter builds a practical market entry system. We will examine how a sponsor selects a market, chooses a wrapper such as a UCITS fund, designs currency and income share classes, obtains permission to market, earns platform or distributor access, and supports investors after the first subscription. We will also test the economics. A cross-border launch can look impressive in a press release and still lose money for years if assets do not cover the fixed operating burden. The central lesson is simple. A successful strategy is not automatically a successful product, and a successful product is not automatically a successful distribution business. Global asset gathering requires all three to work together. Finance loves the phrase scalable platform. Chapter 18 asks the less glamorous question: scalable for whom, under which rules, and after how many invoices? A successful U.S. mutual fund cannot simply be exported by changing dollars to euros and translating the brochure. The investment strategy may travel, but the legal product must be rebuilt around the target market. That can mean a UCITS wrapper, local registration or notification, a management company and board, a depositary, translated and locally compliant disclosure, currency share classes, tax reporting, platform data, local distributor agreements, and service across time zones. The opportunity is substantial. European UCITS and AIF assets crossed 25 trillion euros in 2025, and UCITS net sales reached a record 828 billion euros. Cross-border notifications were also highly concentrated, with Luxembourg accounting for 59% and Ireland 30% in the ESMA data shown here. Those numbers explain why global firms care about these domiciles, but they do not guarantee success for any individual launch. A strong U.S. track record may earn the first meeting. It does not automatically earn shelf space, local advisor trust, or investor assets. The sponsor still has to solve product, permission, platform, people, price, and post-sale service. Global scale can reduce unit cost only after the firm absorbs substantial fixed complexity. In other words, copy, paste, and translate is not a market entry strategy. It is how a very expensive project acquires its first three files. This chapter develops four practical abilities. First, design. You should be able to choose a target market, investor segment, wrapper, domicile, mandate, share class architecture, benchmark, liquidity terms, and service model that fit together. Second, trace. You should be able to follow the product from authorization through passporting or notification, disclosure, distributor onboarding, subscription, settlement, reporting, complaints, and ongoing client service. Third, evaluate. That means testing product market fit, local competition, pricing, tax, regulation, AML and KYC requirements, data, operating capacity, distribution economics, and reputation risk. A large market statistic is not enough. The sponsor needs evidence that a specific product can win through a specific channel at a sustainable cost. Fourth, decide. You should be able to build a go or no-go case with break-even assets, named owners, launch milestones, monitoring metrics, and an exit plan. The distinction to carry throughout the chapter is between global investment capability and global distribution capability. A portfolio team may already know how to manage the strategy. That does not mean the firm knows how to manufacture and support the product in another legal and commercial system. Great investing can survive without a translated fact sheet. Great cross-border asset gathering cannot. By the end, you should be able to identify which capability is missing before the firm discovers the answer through several years of negative contribution margin. 4 connected questions organize the chapter. First, the market. Who is the intended investor? How does that investor save? Which channels control access? What products already compete for the allocation? And how do tax, currency, pricing, and brand credibility affect demand? Second, the product. Which wrapper, domicile, mandate, benchmark, liquidity terms, disclosure, and share classes fit that market without distorting the investment strategy? Third, the distribution engine. Banks, insurers, advisors, platforms, pensions, consultants, wholesalers, and digital channels each have different due diligence standards, data requirements, compensation structures, and service expectations. Fourth, the operating model. The management company, board, depositary, administrator, transfer agent, local facilities reporting, AML controls, data, cyber program, and oversight structure must work before the first investor arrives. These are not 4 independent work streams. Market evidence should shape product design. Product design determines which permissions and providers are required. Distribution channels determine which share classes, documents, and data feeds matter. The operating model determines whether those promises can actually be delivered. A scalable launch aligns all 4 before marketing begins. Otherwise, the sponsor may spend a year obtaining permission to sell a product that nobody in the target channel particularly wants. Regulation can open the door. It does not supply the guests. Global asset gathering is a coordinated operating model. The investment team can be centralized, but the product and client experience remain locally accountable. The global investment team runs research, portfolio construction, trading, risk, and capacity. A local or regional product team converts that strategy into a wrapper, prospectus, benchmark, liquidity policy, and share class structure that investors in the target market can use. The management company and board hold regulatory accountability and oversee delegates, valuation, risk, compliance, and conflicts. The depositary and administrator support safekeeping, cash oversight, ownership verification, NAV production, and reporting. Distributors and platforms provide access, advice, order processing, data, and client service. Local investor support handles language, tax documents, complaints, facilities, and communication that makes sense in the market rather than merely sounding translated. The danger is assuming that a shared portfolio makes the legal products interchangeable. It does not. A U.S. fund, a Luxembourg UCITS fund, and a local domestic vehicle may hold similar securities while having different boards, service providers, tax treatment, share classes, disclosures, dealing terms, and investor rights. Scale comes from shared capabilities, not from pretending the entities are the same. Delegation can move the work. It cannot move the responsibility into another dimension. When something breaks, the investor rarely cares which box on the global operating chart was technically supposed to answer the phone. The process begins with selection, not registration. Step 1 is select. Prioritize the market, investor segment, channel, demand, competition, regulation, tax, and strategic fit. Step 2 is design. Choose the domicile, wrapper, mandate, share classes, currency hedging approach, pricing, liquidity terms, and service providers. Market interviews should change the design before legal documents lock in cost. Step 3 is authorize. Obtain home approval and the required target market registration, passport, notification, or private placement eligibility. Step 4 is onboard. Complete distributor agreements, platform data, due diligence, AML, and KYC controls, operational testing, training, and service level commitments. Step 5 is launch. Seed the fund, publish the documents, open dealing, market compliantly, and support the first subscriptions, confirmations, and reports. Step 6 is scale and govern. Monitor flows. Profitability, client outcomes, complaints, capacity, regulation, service, and each market's continuing viability. The sequence is iterative. A distributor may reveal that the minimum is too high. Operations may show that a proposed hedged class is expensive to control. Legal analysis may make a target segment unattractive. The sponsor should be willing to redesign or stop before launch. Registration creates permission to sell. It does not create demand, shelf access, or economic viability. A regulatory approval is permission to open the store. It is not proof that anyone is waiting outside with a shopping list. The wrapper determines who can buy, how the fund is governed, what it may hold, how it distributes, and which operating costs follow the product. A U.S. 40 Act fund is built for the U.S. registered fund market with its own disclosure, board, tax, liquidity, and distribution framework. A UCITS fund is an EU-regulated transferable securities vehicle used widely for retail and cross-border distribution within Europe and in many markets beyond it. An AIF covers European alternative fund structures outside the UCITS framework with investor and marketing rules that vary by structure and jurisdiction. A local domestic fund may fit local tax, pension, savings, language, or distributor systems better than a portable international wrapper, but it sacrifices standardization. A private placement can target eligible professional or institutional investors under market-specific exemptions. A master feeder structure can pool several tax or investor-specific feeders into one portfolio while adding allocation, governance, and operational complexity. One strategy may therefore appear in several wrappers. That can expand access, but it also multiplies legal entities, boards, audits, tax work, documents, service provider relationships, and oversight. The most portable wrapper is not always the best wrapper for the intended investor. A passport is valuable. So is arriving at the correct destination. Choosing a wrapper because every competitor has one is not strategy. It is regulatory peer pressure with annual fees. U.S. registered funds and UCITS funds share important principles, including pooled ownership, disclosure, oversight, asset safekeeping, valuation, and investor protection. But they are cousins, not twins. In the United States, a fund board, including independent directors, oversees the advisor and key conflicts. Distribution may run through brokers, advisors, retirement plans, direct channels, banks, insurers, and platforms. Disclosure includes prospectuses, shareholder reports, portfolio filings, and fee and performance standards. Tax generally follows the U.S. regulated investment company framework and U.S. shareholder reporting. A UCITS product may use a management company or self-managed structure, a board, a depositary, risk controls, and oversight of delegates. Cross-border distribution may involve a passport or notification plus local marketing, facilities channel, and investor requirements. Retail disclosure can include the PRIPS KID, along with prospectus and periodic reporting. Tax depends on domicile, treaties, investor status, local reporting, and share class design. UCITS is widely recognized, but it is not automatic permission in every non-EU market. The same portfolio strategy can therefore produce different investor rights, documents, tax outcomes, service obligations, and economics. That is why cross-border analysis cannot stop at holdings. Investors may own similar bonds or stocks through products that behave differently operationally. The portfolio may rhyme, the wrapper writes the contract. Cross-border profitability depends on scale after fixed complexity. The simplified contribution margin equation is assets multiplied by the net revenue rate minus product cost, distribution cost, and local operating cost. Start with assets. The model needs realistic assumptions for seed capital, flows, market movement, retention, capacity, and the time required to reach scale. A heroic asset ramp can make almost any launch look attractive. That is why it is heroic. Next, use net revenue, not the headline management fee. Deduct fee waivers, rebates, share class differences, revenue sharing, and distributor economics. Then include fixed costs such as legal work, registration, the board, management company, depositary, administration, audit, disclosure, tax, and governance. Variable costs can include platform fees, local service, data, translation, reporting, hedging, and sales support. The example on the slide is intentionally sobering. At a 30 basis point net revenue rate, 500 million euros of assets produces 1.5 million euros of annual revenue before those costs. 500 million sounds like a large fund until the revenue is asked to pay everyone who made the fund possible. A launch can attract assets and still destroy value if the fee mix is weak or the operating footprint is too broad. Strategic value may justify a period below break even, but the rationale should be explicit, measured, and time-bounded. Otherwise, the strategy is not patient capital. It is a cost center with excellent branding. Share class architecture is the localization layer that allows one portfolio to serve investors with different currencies, income preferences, minimums, fee arrangements, and distribution rules. A currency class lets investors subscribe and receive reporting in a chosen currency, but that does not necessarily remove the economic currency exposure. A hedged class uses derivatives to reduce class-level currency risk and creates its own gains, losses, collateral, basis, and accounting requirements. An accumulating class retains distributable income in NAV. A distributing class pays income or managed distributions under its stated policy. Retail and institutional classes may differ in minimums, eligibility, fees, service, and channel arrangements. Cleaner rebate structures separate or adjust distribution compensation to fit local advice and platform rules. Each class can solve a real commercial or investor need. Each class is also a new promise that operations must keep every day. Hedging must be allocated correctly. Expenses and income must be assigned to the right class. Documents, tax data, platform identifiers, and performance histories must remain accurate. Too few classes can make the fund unusable in a market. Too many can fragment assets and increase error risk. Share classes are not free accessories added by clicking a menu. They are small operating businesses attached to one portfolio, each with a different invoice and occasionally a strong opinion about the euro. Local distribution is built through institutions, relationships, and an operating integration. Banks and insurers may control large retail networks, approved product lists, advisor processes, and centralized due diligence. Financial advisors need a clear client use case, local research support, training service, and the correct regulatory setup. Platforms require dealing connectivity, documents, data, identifiers, rebates or clean pricing, due diligence, and dependable service levels. Pensions and consultants often use formal searches, institutional classes, governance reviews, capacity analysis, and detailed reporting. Wholesalers translate investment capability into portfolio applications and maintain intermediary relationships over time. Digital channels can scale access, but they still require local marketing, suitability, or appropriateness processes where applicable, payments, data, complaints, and support. This is why translation alone fails. The sponsor must know who controls the client relationship, what evidence earns shelf access, how the product fits an existing portfolio, and which systems must exchange information. A famous global brand may open the meeting. Local product fit, integration, and service win the allocation. A distributor's shelf is not a museum for impressive strategies. Every product must justify the space, the training, the operational work, and the risk. The portfolio manager may deliver alpha. The platform still wants the data file before the cutoff. Europe entered 2026 with record fund scale and strong UCITS demand. The slide reports more than 25 trillion euros in combined UCITS and AIF assets at year-end 2025, total net inflows of 873 billion euros, and UCITS net sales of 828 billion. Bond UCITS attracted 304 billion euros, equity UCITS 247 billion, equity ETFs 261 billion, and multi-asset UCITS 79 billion. These are important market signals. They show large pools of savings, substantial demand for regulated fund structures, and strong interest across bonds, equities, and exchange-traded products. They also show why competition is intense. Large markets attract established brands, local specialists, global managers, low-cost providers, banks, insurers, and platforms with their own product economics. The correct conclusion is not simply Europe is large, therefore launch. The sponsor must ask which part of the flow is addressable, which channel controls it, whether the proposed product is differentiated, and what fee and service model can compete. Aggregate inflows can coexist with hundreds of funds receiving little or no net new money. A rising tide may lift many boats. It does not reserve your firm a dock, a distributor, or a profitable share class. Use the data to size the opportunity, then return to product market fit. The UCITS framework became a global product passport through repeated harmonization rather than one dramatic event. UCITS 1 in 1985 created a common European framework for transferable securities funds. UCITS 3 in 2001 broadened eligible assets, investment techniques, and management company provisions. UCITS 4 in 2009 strengthened passporting, mergers, master feeder structures, and investor information. UCITS 5 in 2014 enhanced depository duties, remuneration rules, and sanctions. From 2018 through 2023, the PRIPS KID became a central retail disclosure document, emphasizing concise risk, scenarios, cost, and complaint information. The 2026 ESMA notification data on the slide show Luxembourg and Ireland accounting for 59 and 30% of cross-border fund notifications. Together, that is 89%, which illustrates the powerful infrastructure and network effects built around those domiciles. The timeline also shows what the passport does not do. Harmonization can reduce duplicative authorization and make the wrapper recognizable. It does not eliminate local marketing rules, tax, language, channel requirements, facilities, data, or service. The word passport is useful, but it can be misleading. A passport allows travel. It does not guarantee a hotel room, a client meeting, or anyone buying the fund when it arrives. Cross-border success still depends on local execution after the legal door opens. Consider the illustrative case. A U.S. sponsor creates a Luxembourg UCITS version of a successful concentrated equity strategy. The investment record is strong. The product uses a high minimum institutional class, distributes income, reports in U.S. dollars, and offers monthly dealing. The sales plan targets bank wealth platforms whose clients prefer daily dealing, accumulating euro classes, lower minimums, and local language portfolio risk reporting. Assets stall below break even. The failure is not primarily investment quality, it is product and channel mismatch. The liquidity terms do not fit the distributor's client experience. The class structure does not match currency, income, or minimum preferences. The reporting and onboarding work were treated as marketing details rather than platform requirements. Fixed UCITS, local data, translation, and distribution costs then overwhelm the limited revenue base. The response should not be add every requested feature immediately. Daily dealing must be consistent with the strategy's actual liquidity. New classes require controls and sufficient demand. The sponsor should revisit the target segment, distributor evidence, economics, and whether an institutional channel is a better fit. Product redesign is justified only when the strategy and governance can support it without harming existing investors. The strategy was strong, but the product showed up to the wrong party wearing the wrong share class. Performance can start a conversation. It cannot repair an operating model that was designed for a different guest list. Market entry is a portfolio of commercial choices. The most attractive market may also be the hardest to enter. Commercial attractiveness includes addressable assets, growth, fee levels, unmet investor needs, competition, and strategic relevance. Execution feasibility includes regulation, wrapper fit, distribution access, brand credibility, language, data, service providers, tax, AML, operating complexity, and the time required to scale. Existing institutional clients may be relatively easy to serve because the relationship, mandate, and buying process are already understood. A home region extension may add manageable complexity. A professional UCITS channel may offer portability without the full burden of mass retail. A large retail bank can provide enormous reach, but it may demand low fees, multiple share classes, extensive integration, and long due diligence cycles. A local pension market may be attractive, yet require specific reporting, local credentials, and consultant support. A new retail jurisdiction can combine large potential with the greatest fixed cost and execution risk. Sequencing matters. A firm can build capability through adjacent markets before attempting the most complex retail launch. That creates evidence, provider relationships, and operating muscle. The biggest market is not automatically the best first market. In global distribution, ambition without sequencing is simply a more international form of impatience. Start where the firm has a credible path to win, learn, and scale, then expand with evidence. A cross-border go or no-go decision should require evidence in 6 areas. First, market. Define the target segment, saving system, assets growth, competitors, fees, tax, and unmet need. Second, product. Confirm the wrapper, domicile, mandate, liquidity, share classes, benchmark, capacity, disclosure, and intended investor outcome. Third, permission, map authorization, passporting, notification, marketing, advice, AML and KYC, data, tax, and local legal requirements. Fourth, distribution, identify name channels, pipeline evidence, shelf criteria, agreements, compensation, training, service, and the people responsible for relationships. Fifth, operations, confirm the management company, board, depositary, administrator, transfer agent, reporting, language, cyber, data, and delegate oversight. Six, economics and exit, set seed, asset ramp, net revenue, fixed and variable costs, break even, milestones, and the plan for closure, merger, or withdrawal if the thesis fails. The exit plan matters because products can become small, unprofitable, or strategically obsolete. Closing a cross-border fund affects investors, distributors, regulators, tax, operations, reputation, and employee incentives. It is easier to define decision rules before the launch becomes emotionally attached to the annual report. Permission without distribution is a cost center. Distribution without governance is a risk event. A good launch committee should be capable of saying no while everyone is still excited, which is precisely when saying no is most economically valuable. Pause here and build a recommendation before hearing the analysis. The sponsor has a $6 billion U.S. Core Plus bond strategy and is considering a UCITS launch for European professional and wealth investors. The strategy uses derivatives, agency mortgages, high yield, and 10% less liquid credit. Distributors report positive interest, but they want daily dealing, euro-hedged accumulating classes, a 3-page PRIPS KID, sustainability disclosures, and at least 50 million euros of seed. The proposed net management fee is 35 basis points. Fixed launch and annual operating cost is 1.8 million euros before distribution compensation and internal sales expense. Start with product eligibility and investor protection. Can the strategy satisfy UCITS eligibility, diversification, derivatives, valuation, liquidity, and daily dealing requirements in normal and stressed markets? 10% less liquid credit deserves particular scrutiny because investor redemption terms should not outrun the portfolio's ability to produce cash fairly. Next, test the hedged accumulating classes. The sponsor needs FX execution, collateral, class level allocation, NAV controls, disclosure, and monitoring of hedge slippage. Then calculate simple fixed cost break even. 1.8 million divided by 0.0035 equals roughly 514 million euros. Actual break even is higher after distribution and internal sales costs. A 50 million euro seed is less than 1/10 of that fixed cost threshold. My recommendation is a conditional no-go until the firm has confirmed product eligibility, daily liquidity stress capacity, operating controls, named distributor commitments, a credible asset ramp, governance owners, and exit criteria. Positive interviews are encouraging. They are not assets. In global distribution, enthusiasm is not yet a subscription order. Pause the presentation and answer all 4 questions before checking, the explanations. Question 1, what does a UCITS passport generally facilitate? Is it automatic global tax exemption, cross-border marketing within the EU after required authorization or notification processes, guaranteed distribution, or a performance fee? Question 2, what maximum length is highlighted for a PRIPS KID? Is it 1 page, 3 pages, 20 pages, or no limit? Question 3, why create currency hedge share classes? Is it to guarantee a return, reduce class level currency exposure for certain investors, remove all portfolio risk, or avoid NAV calculation? Question 4, what is the best evidence that a market launch is viable? Is it a large market statistic, product fit plus permission, plus named distribution demand, plus operational readiness and credible economics, a translated brochure, or a famous portfolio manager alone? Pause now and write 1 sentence explaining each answer. When you're ready, resume. The correct answers are: the passport can facilitate cross-border marketing within the EU through the required authorization and notification process. The PRIPS KID is highlighted as a maximum of 3 pages. A hedge class seeks to reduce class level currency exposure, but adds cost, basis, collateral, and accounting risk. And launch viability requires evidence across product, permission, distribution, operations, governance, and economics. The explanation matters more than the letter. Multiple choice can reward a lucky click. Distributor due diligence is less sentimental. Carry 6 claims forward. First, strategy does not equal product. A global investment capability must be converted into a locally valid wrapper, share class, disclosure package, liquidity promise, and service model. Second, a passport is not distribution. Permission to market does not create shelf access, advisor attention, brand trust, or client demand. Third, localization adds complexity. Currency, hedging, income policy, minimums, language, tax, data, and compensation create class and market variation. Fourth, distributors control access. Banks, advisors, platforms, pensions, consultants, wholesalers, and digital channels require evidence, integration, and ongoing service. Fifth, scale must cover fixed cost. Registration, boards, management companies, depositaries, administrators, audits, disclosure, translation, and local support create high break-even assets. Sixth, governance travels with the fund. Centralization and delegation do not remove local legal accountability, oversight, investor outcome responsibility, or the need for an exit plan. The larger course synthesis is that the modern fund industry is a connected system. Portfolio judgment, investor protection, distribution, operations, and global regulation cannot be managed as separate islands. Registration is a passport, not a boarding pass, and certainly not a sales forecast. The sponsor succeeds only when the strategy, product, channel, controls, and economics remain aligned after launch, not merely on the day the press release goes out. This final page is the refresh register for Chapter 18 in the course. Posen and Hamacher provide the operating architecture. EFAMA supplies the 2025 European Fund statistics and UCITS flow data. ESMA provides the January 2026 cross-border marketing and notification statistics. European Commission materials explain the UCITS framework and the PRIPS key information document. The Investment Company Institute provides wider industry context. IOSCO materials help frame international collective investment and cross-border regulatory principles. Local regulators, tax authorities, distributors, data providers, and AML and KYC rules must still be checked for each target market. Do not read the long web addresses allowed in the video. Use them as the evidence trail behind the chapter. Each source answers a different question. Official statistics can describe market size and flows. Regulatory sources can define permission, disclosure, and governance. None of them proves that a particular sponsor has a viable product, a committed distributor, or a profitable asset ramp. Those conclusions require current documents, legal and tax advice, operating evidence, channel interviews, and a documented financial model. The course began by asking why investors use mutual funds. It ends by showing how many systems must cooperate to deliver that apparently simple pool product around the world. The portfolio is only the center. Around it sit governance, operations, costs, distribution, technology, regulation, and trust. Finance rarely eliminates complexity. It usually packages it attractively and assigns it to several committees. Your job is to know which committee owns the risk before the investor does.